Assalamualaikum and very good morning to our respected lecturer and everyone watching this presentation. My name is Mashita Hakimah binti Hashim and my metric number is 1232743. Today, I will be presenting the first part of our group assignment. Our presentation focuses on the master budget and cost volume profit analysis prepared for Crispy Delight Food Industry Sendirian Berhad for the first quarter for 2036. For my part, I will briefly introduce the company, explain the objective of this report, and discuss why preparing a master budget is important for the company future expansion. So, let's begin. Before we discuss the budgeting process, let me briefly introduce the company. Crispy Delight Food Industry Sendirian Berhad is a local company that produces packaged banana chips. The company currently supplies its product to distributors in Negeri Sembilan, Melaka, and Johor and plan to expand its business throughout Peninsula Malaysia. To support the expansion, the company needs proper financial planning. However, Crispy Delight has never prepared a formal master budget. Therefore, this report provides a structured budgeting system to help the company manage its operation and achieve its expansion goals. The main objective of this report is to prepare a master budget for the first quarter of 2026. The master budget combines several individual budgets, including the sales budget, production budget, direct material budget, direct labor budget, manufacturing overhead budget, selling and admin expense budget, cash budget, and budgeted financial statement. By preparing this budget, the company can plan its activities more effectively, manage its resources efficiently, and make better financial decisions. Now, I would like to explain why the master budget is important for Crispy Delight. In managerial accounting, a master budget helps management in three main areas: planning, controlling, and decision making. First is planning. A master budget allows the company to plan its activity in advance instead of making decisions at the last minute. For the example, the company planned to increase sales from 30,000 packets in January to 35,000 packets in March. Based on the forecast, management can estimate the amount of raw material, labor, and production needed to meet customer demand. The second function is controlling. The budget provides a standard for measuring the company performance. At the end of each month, management compare the actual result with the budget. If there are any differences, such as higher production costs or material wastage, management can identify the problem early and take corrective action to avoid unnecessary losses. Finally, the third function is decision making. The company plans to invest 240,000 in new production equipment and also a 150,000 special employee bonus in March. There are major financial commitments. By preparing a cash budget, management can estimate future cash inflow and outflow, decide when financing is needed, and ensure that the company maintains sufficient cash to support its daily operation while continuing its expansion. Overall, the master budget gives management a clear financial plan and help the company achieve its goal with greater confidence. That's all from me. Next, let's continue with the next section.
Next, I will explain the sales and production budget overview. Firstly, the sales budget shows a positive sales trend throughout the budgeting period. Sales are projected to increase steadily from 30,000 units in January to 38,000 units in May, with total first quarter sales reaching 97,000 units. This indicates growing customer demand and a positive market outlook. To support this increase in sales, the company plans its production carefully. The production budget is prepared based on forecasted sales while maintaining the required ending inventory. This inventory policy helps ensure that enough products are available to satisfy customer demand without causing stock shortages. Overall, the production budget is well aligned with the sales forecast and support smooth business operations. Next is the cost budget overview. As production increases, the company also expects higher operating costs. Firstly, direct material costs increase because more raw materials are required for higher production. Secondly, direct labor costs also increase since additional production requires more labor hours, although the wage rate remains unchanged. For manufacturing overhead, the variable overhead increases together with production activity while the fixed overhead remains relatively stable throughout the budgeting period. Lastly, selling and administrative expenses also increase as sales grow mainly due to higher selling activities, while fixed administrative costs remain under control. Overall, the cost budget shows that high operating costs are a normal consequence of increasing production and sales activities. Finally, I will explain the cash budget overview. The company's main cash inflows come from customer collections. Meanwhile, the major cash outflows include payments for raw materials, direct labor, manufacturing overhead, selling and administrative expenses, as well as capital expenditures. One important point is that the company plans to purchase a new machine and a delivery truck to support future business expansion. These investments create significant cash outflows during the budgeting period. However, despite these large investments, the company is still able to maintain a positive ending cash balance. This shows that the cash budget has been planned effectively, ensuring sufficient liquidity to support both daily operations and future growth. Therefore, the cash budget helps management anticipate future cash requirements and avoid liquidity problems.
Next, let's focus on our cost volume profit or CVP analysis. CVP is our primary tool for evaluating how changes in volume and cost directly impact our bottom line operating profit. Our product is positioned at a selling price of 18 ringgit per unit with variable cost sitting at 6 ringgit 45 cent per unit. This leaves us with a strong contribution margin per unit of 11 ringgit 55 cent. To put this in perspective, let's look at our contribution margin ratio, which stands at 64.17%. This tells us that for every single ringgit of sales revenue we bring in, approximately 64 cents directly contributes toward covering our fixed costs and eventually generating clear profit. The remaining 36 cents goes toward our variable manufacturing and operational expenses. Now let's address our break-even point calculated in this slide. Our total fixed costs amount to a substantial 435,849 ringgit. To calculate our break-even volume, we divide this total fixed cost by our unit contribution margin of 11 ringgit and 55 cent. This reveals that we must sell at least 37,736 units of our product. As calculated, multiplying our break-even units by our 18 ringgit selling price gives us a break-even sales value of 679,248 ringgit. This is our absolute baseline revenue target.
Next, I will present the impact of increasing the selling price on the company's operating income. We analyze two different scenarios. In the first scenario, the selling price increases by 15% from 18 ringgit to 20 ringgit and 70 cent, together with an additional advertising expense of 10,000 ringgit. Based on our analysis, the company will achieve an operating income of 936,401. In the second scenario, the selling price increases by 25% to 22 ringgit 50 cent with additional advertising expenses of 50,000. Although advertising costs are higher, the company is expected to earn an operating income of 1,106,1 ringgit, which is higher than the first scenario. Therefore, both pricing strategies improve profitability, but the 25% selling price increase provides the highest operating income. Next, the company aims to achieve a target operating profit of 3,000 ringgit. Based on our CVP analysis, Crispy Delight needs to sell approximately 60,710 units to achieve this target. To increase sales, management can expand its distribution network, strengthen digital marketing, introduce promotional campaigns, and build stronger relationship with distributors and also customers. Besides setting sales target, CVP analysis also supports management in several important areas. Firstly, if assists in pricing decision through the contribution margin ratio of 64.17%, helping management set competitive prices while maintaining profitability. Secondly, it supports cost control by showing how changes in costs affect the break-even point of 37,736 units. Thirdly, it improves sales planning by providing a clear sales target for the company. In addition, the margin of safety of 61.10,000 indicates that the company has a relatively strong buffer before experiencing losses, reducing the financial risk of expansion. Finally, CVP analysis helps management forecast future profits by evaluating different pricing, costs, and sales scenarios before making important business decisions. In conclusion, this assignment demonstrates that both the master budget and CVP analysis play an important role in supporting business decision-making. The master budget provides a clear financial plan, while CVP analysis helps management make better decisions on pricing, cost control, sales planning, risk assessment, and also profit forecasting. Therefore, we recommend that Crispy Delight continue applying these tools to support its nationwide expansion while maintaining profitability, improving operational efficiency, and also achieving sustainable long-term growth.